Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from Peter. Alan, wouldn't it be more accurate to use a portfolio average for ROE, return on option, upside potential, and downside protection instead of straight calculations for each stock? Thanks, and it's signed Peter. Okay, well, it appears that what Peter wants to do here is to take our strategy guidelines and instead of making it for each individual stock, make it a portfolio average. So for example, I've published in my books and DVDs and blog articles for years that my initial return goals, time value premium, is 2 to 4% a month. I shoot for lower, more conservative returns of 1 to 2%, my mom's account. And of course it'll vary from person to person. So what Peter is suggesting, instead of looking at those kind of returns for each stock and required for each individual stock, make it an entire portfolio requirement and then go from there. So that's the hypothetical that we're going to use as we develop this video. Alright, so what I did was I took a look when I made this video, which is in March of 2018, and I selected 3 securities from my premium stock watch list. Those securities were Applied Materials, ticker AMAT, On Assignment Inc., ticker ASGN, and Five Below Inc., ticker FIVE. Now what we did next was we went to the option chains. Now, I made this video with 3 weeks remaining in the April contracts. So these are going to be now 3-week returns, not full 1-month returns. So let's go to the options chain for the first security, Applied Materials, which at the time that I made this screenshot was trading at 54.23. Once again, these are 3-week returns. Now looking at the options chain, we're going to look at the 52, 54, and 56 strikes. The 52 would be a good strike selection for a bear portfolio with downside protection. You could see that the bid price was $4.15. The 54 might be a strike we'd select in a mixed or average portfolio with a bid price of $2.91. And in the yellow highlighted field, we have the 56 out of the money strike, which would be for a bull portfolio, and that generated $1.94. Okay, let's move on now to the options chain for ASGN. At the time was trading at 79.79, and we're going to use the 75 in the money strike in a bear portfolio, highlighted in the brown field, with a bid price of $8.60. We're going to look at the 80 out of the money strike with a bid price of $2.55, highlighted in the yellow field for our bull portfolio, and a possible strike in a mixed portfolio for the 85 well out of the money strike, which generated a bid price of 55 cents. And finally, we're going to look at the options chain for FIVE, and that was trading at 70.86 at the time that I made this screenshot. And we're going to look at the 65 in the money strike as a possible strike for our mixed portfolio or average portfolio. We're going to look at the 70 in the money strike highlighted in the brown field for our bear portfolio. That was a bid price of $3.10. And in the yellow highlighted field, the out of the money 75 strike, which generated a bid price of 0.995. Once again, that was in the yellow field. All right, let's establish our 3 portfolios, bull, bear, and averaged, and see what the information tells us. First, the bull portfolio, which generally is going to be out of the money strikes because it gives us the opportunity to generate a time value premium plus share appreciation from current market value up to the strike price. And we feed the information into the multiple tab of the Ellman Calculator. And here we could see that AMAT, ASGN, and FIVE, we used all out of the money strikes, and those generated return on options or ROEs of 3.6, 3.2, and 1.3%, as you could see on the right side of the screenshot. And that averaged out to a ROE, or return on option, of 2.7%, certainly well within our 2 to 4% range as far as initial time value premium. Now, the average upside potential was 3.1%, which means that in an ideal world, if everything went just perfectly, we had the opportunity to generate a 5.8% 3-week return using these out-of-the-money strikes. All right, next let's have a look at a possible bear portfolio using in-the-money strikes for each particular security. And here we can see for the 3 securities selected, all in-the-money strikes, and that led to a ROE average of 4.0% at the high end of our 2 to 4% range. Now, had it gone a little bit above 4.2, 4.5, 4.6, it still would be acceptable. These are just guidelines. But it averaged out exactly to 4.0. Now, no upside potential, of course, when you're using in-the-money strikes. We cannot get any additional premium in terms of time value return when we're selling in-the-money strikes. But we do have downside protection, and that averaged out to a nice juicy 3.8%. So here we have a situation where we are guaranteed a 4.0% 3-week return as long as share value does not decline by more than 3.8%. Once again, these are averages. So we can see a pretty nice situation set up here with the bear portfolio. Now let's have a look at the averaged or mixed portfolio, which simply means that the average of the return on our options is going to fall within those guidelines, but not specifically each individual security. So for example, here with the 3 securities where we used mixed in-the-money and out-of-the-money strikes just to get an average that meets our guidelines, we see that the average ROE is 2.2%, which does fall within our 2 to 4% requirement. However, if you look down the ROE column on the right side, third from the end, you see that most of that heavy legwork was done by Applied Materials, AMAT, which gave you a 5% 3-week return. The others were below average. Now, upside potential, you could see that it averaged out to 2.2%, but that was really all ASGN. And finally, downside protection of 2.9% average, and that was all done by the deep in the money strike FIVE. So here we did have results that met our guidelines, but if you took a look specifically at each individual stock, you could see that some fell a little bit short and were pulled up by one of the others. Let's do a comparison spreadsheet so we can actually see this graphically, how these portfolio returns played out. Now, in the bull portfolio, we had a 2.7% 3-week return. The bear portfolio, 4.0%. Now, that's time value only. And the average portfolio, 2.2%. So it kind of underperformed the other two, even though the results were very, very good. Upside potential in the bull portfolio, 3.1, compared to 2.2 in the average portfolio. And finally, downside protection in the bear portfolio, 3.8, compared to 2.9 in the averaged or mixed portfolio. So what these results are showing us is that the average portfolio did have good results, but by using each individual stock and require our guidelines to meet those for each individual stock, we did even better. All right, let's summarize now. Overall, portfolio returns can be maximized by requiring each security within that portfolio to meet our system guidelines. That applies to return on option, it applies to downside protection when we're bearish, and it applies to upside potential when we're bullish. So, don't settle for decent returns. Blue-collar investors always strive to get the best possible returns, and that's what we want for ourselves, and that's what we want for all of you. So Peter, thank you very much for this question, because it allows us to break down how we set up and structure our portfolios, and shows us that even if our portfolio meets our system guidelines, we could do way, way better by making sure that each security within that portfolio also meets our system requirements. So thanks so much for that. And of course, thanks to everybody out there for taking the time to watch this video. I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.